Hi, I'm Roy from Financial Intake. Welcome to Chevron's Q3 financial report. In today's video, we're diving deep into Chevron's latest results, including key financials, operational achievements, and strategic moves you need to know. Whether you're an investor, financial enthusiast, or just looking to understand the energy sector better, this breakdown will give you a clear, valuable look at Chevron's performance and what it could mean for the future. Let's dive in. This quarter, Chevron delivered robust results, setting records in shareholder returns and meeting project milestones projected to support long-term growth. Production rose 7%, driven by strong Permian performance and timely turnarounds at TCO and Gorgon. Major projects like the high-pressure Anchor project and water injection at Jack St. Malo and Tahiti fields are underway, with Gulf of Mexico production expected to reach 300,000 barrels per day by 2026. Additionally, Chevron expanded its CO2 storage portfolio by over 2 million acres offshore in Western Australia, emphasizing its commitment to sustainability. Lastly, the merger with Hess received FTC clearance, and recent asset sales further optimized Chevron's portfolio. Celebrating 1 year since acquiring PDC Energy, Chevron has fully integrated the two companies, achieving more than $1 billion in additional free cash flow and surpassing initial synergy guidance by 30%, while performance stands 40% above DJ Basin averages, with 75% of inventory positions at a break-even below $50 per barrel. The shale and tight portfolio integration optimizes production, sustaining an expected plateau of 400,000 barrels daily through the decade. Operations in Colorado continue as one of the industry's lowest carbon intensity assets, showcasing Chevron's leading role in sustainable energy production. At TCO, Chevron's team is making steady progress on strategic milestones. With all four pressure boost facilities online and operational, TCO achieved the highest daily production in its 31-year history. Remaining conversions and leak testing are underway, leading to the planned startup of wet sour gas compressors by Q1 2025. These advancements position TCO to maximize throughput and efficiency, contributing to Chevron's broader goals in operational excellence and production growth. Chevron continues to divest non-core assets, announcing sales in Canada, Alaska, and Congo, which, pending approvals, are projected to bring in around $8 billion pre-tax. Notably, Chevron received a strong offer for its Kaybob Duvernay shale and non-operated interest in the Athabasca oil sands project, recognizing strategic fits for reputable buyers. These divestitures support Chevron's portfolio optimization strategy, positioning it to capitalize on core strengths and value-generating opportunities. Chevron reported third-quarter earnings of $4.5 billion, or $2.48 per share, with adjusted earnings slightly higher at $2.51 per share. Organic capex remained on target at $4.0 billion. Ending the quarter with a net debt ratio under 12%, Chevron's financial standing remains one of the strongest in the industry, emphasizing its disciplined approach to capital allocation and shareholder value. Despite lower oil prices, Chevron saw record cash flow for the year, boosted by a $1.4 billion reduction in working capital. Share repurchases reached a quarterly record of $4.7 billion. Chevron's financial priorities remain consistent, leveraging its balance sheet strength to reward shareholders across market cycles, reinforcing the company's commitment to long-term value. Adjusted earnings were down $150 million from last quarter, impacted by lower liquid realizations and higher DD&A at TCO. Upstream earnings declined, while downstream earnings saw a lift from favorable timing effects and increased U.S. volumes, although offset by lower refining margins. This balance underscores Chevron's ability to adjust and maintain profitability amid varied market conditions. Compared to Q3 last year, adjusted earnings dropped by $1.2 billion, impacted by lower refining margins and increased interest expenses. However, adjusted upstream earnings held steady, with improved liftings and timing effects compensating for lower liquid realizations and higher DD&A. Chevron remains focused on managing costs effectively to mitigate market fluctuations and uphold shareholder value. Chevron's Q3 oil equivalent production increased by approximately 70,000 barrels per day, mainly driven by strong New Mexico assets in the Permian. Full-year production growth is now expected to hit the high end of the guidance range, between 4 to 7%. These results showcase Chevron's ongoing efforts to optimize production in key regions and meet its growth targets. Managing costs effectively is critical for Chevron's long-term strategy. Known for keeping unit costs below inflation, Chevron has successfully integrated acquisitions while ensuring safe, reliable operations. Turnarounds remain on schedule, supporting operational uptime and lowering unit costs. With planned structural cost reductions of $2 to $3 billion by 2026, Chevron aims to enhance productivity and leverage global capability centers, positioning itself for competitive advantage. Looking ahead, Chevron anticipates downtime in upstream operations, with maintenance scheduled for El Segundo, Pascagoula, and a shutdown at Pasadena to support the light tight oil expansion. Asset divestments will impact production by approximately 45,000 barrels per day. Chevron expects affiliate dividends near $1 billion, with continued share repurchases up to $4.75 billion. Proceeds from divestitures are anticipated at approximately $8 billion. This outlook underscores Chevron's balanced approach to growth, cost management, and shareholder returns. Thank you for joining us in reviewing Chevron's Q3 financial performance and operational progress. Chevron continues to execute its growth, portfolio optimization, and sustainability goals, setting a strong foundation for long-term value. We look forward to keeping you updated on Chevron's journey through upcoming quarters. Please don't forget to like and subscribe for more insights. Stay tuned for more quick reviews,